Welcome to the last sort of elective session for Mises U. We're going to have lunch at 12:30. Guido Holzman will talk to you this afternoon. Then we will. Some of you will go to the oral exams, which you will sit before a jury of us, and we'll fire questions about. We'll fire questions about Austrian Economics and market processes at you. Okay. Some of those questions might involve what I'm going to talk about during, say, the next hour or so. The title of the session is Short Selling, Explanation and Defense. If this were just about short selling, it would be about 5 minutes long. Instead, we're going to talk about the role of financial markets and the role of financial instruments in a market economy, and we're going to talk about how those instruments make the market work the way that we think it does. We're going to draw some implications from some of the lectures that you've heard over the course of the week, and we're going to see how financial markets help us answer this "how do you know?" question. Okay? Because there are implications of financial instruments for how you know and whether we think we should believe what you say you know about the world as you think you see it. So the financial crisis has given regulators the opportunity to do anything. Do something. Holy crap, everything's just going to hell in a handbasket. Do something, do something, do something. Last fall, they did something. They outlawed short selling. Okay? Right now, with gas prices fluctuating, they're saying, well, they're fluctuating because of oil speculators. Therefore, you should do something. You should outlaw oil speculation. Okay? Indeed, one test for whether someone in the media knows what they're talking about is if you see someone who says fluctuations in gas prices or fluctuations in oil prices are due to speculation rather than supply and demand, this suggests that they don't really know what they're talking about. Okay? Because speculation is itself part of the process of supply and demand. In every transaction that you make, you speculate. So we'll talk about short selling, we'll talk about oil markets and futures, and we'll have a bit of discussion. One of my favorite quotes from any economist anywhere ever, Friedrich Hayek, who said, "The curious task of economics is to demonstrate to men how little they really know about what they imagine they can design." Okay? Dwell on that for just a second. The curious task of careful economic reasoning is to demonstrate to men how little they really know about what they imagine they can design. So often, in some cases, people will point at a market outcome and say, well, ex post, this was inefficient. Markets are not efficient aggregators of information because if they were, then we wouldn't have had a financial crisis. This company wouldn't have gone out of business, etc., etc., etc. In fact, it's the market process itself that generates the information that's necessary, as we've said time and time again, for rational economic calculation. So let's consider short selling. The market for assets. You can have two kinds of positions. You can have a long position, or you can have a short position. So let's imagine that these little packets of tea represent shares of stock in Bigelow. David and Eunice Bigelow, the Bigelow Tea Company. Okay? Suppose you own one of these shares. Okay, so you own a share of Bigelow Tea. Everyone, this is Casey Boone from Shippensburg University, owns a share of Bigelow Tea. All right, so let's suppose that you expect the price of those shares to go down. What do? You sell the stock, right? So you sell the stock. Okay? Excellent. Fair enough, right? So if you expect the price to go down, you should sell the stock. Why? Right, you don't want to take a loss. If you think you can sell it for $10 and you think it's going to be $8 tomorrow, you should sell it and save yourself that $2 loss. Okay, now let's suppose that David owns the share. Okay? Everyone, this is David from George Wythe University. So David owns a share, and he's just kind of going on his merry way. Casey thinks that Bigelow Tea is going to go down in price, yet he doesn't own any shares. What should he do? Yeah, he can borrow the share. So he can go into the market and say, "Hey, David, can I borrow your share of Bigelow Tea?" Would you be willing to lend him a share of Bigelow Tea? Okay, for a price maybe. But okay, so let's suppose that David doesn't think that Bigelow Tea is going to go down. So what might he want to do? He might want to hold a long position, and he might want to actually buy shares. Okay, so he's obstinate. He thinks the share price is going to stay constant or rise. He doesn't want to part with his shares necessarily, or maybe he's just being obstinate. Okay, so Casey comes into the market and finds an investment bank, Carden's investment bank. or something like that and says, hey, can I borrow some shares? I say, yeah, absolutely, here. I lend him some shares. Okay. What does he do with the share? He sells it. Right. So he sells a share of stock he doesn't own to Whitney Wogan from Boulder, Colorado, who buys the share. Now, let's suppose the price does, in fact, go down. Okay, so the price goes down from $10 to $8. What does he do? Yeah, he buys the share. He goes and buys the share, then he returns it to the person from whom he has borrowed it. And in so doing, he earns a profit equal to the $2 difference between the $10 price at which he sold the share and the $8 price at which he bought it. Okay? So, he has short sold a share of stock that he didn't actually own, was able to borrow the stock, sell the stock, and earn a profit. Now let's consider a statement that you will see often in the financial press, or that you'll see a lot in public commentary on these kinds of issues. People say, short selling is pushing down stock prices. Casey wanted to short sell stock. Nicholas wanted to short sell stock. Patrick wanted to short sell stock. Fred wanted to short sell stock. Are these short sellers driving down the price of the asset? Is the practice of short selling per se driving down the price of the asset? No, it is not, okay? Why not? Okay, well, demand. Sorry?
They must buy outside of something.
Okay. Okay, if there's going to be a seller of something, then what does there have to be? There has to be a buyer, right? Okay, so the practice of short selling itself, per se, it does not reduce the price of the stock. Okay? Because in any short selling contract, there has to be someone there to buy the asset. So if the short sellers are wrong, so if Casey's wrong, and in fact the price is going to go up or stay constant, and someone thinks that's the case, and they'll be willing to buy that stock that Casey's trying to sell short, they'll be willing to defend the price of the asset. If it turns out that short sellers begin to overwhelm people who wish to hold a long position in the stock, meaning they wish to actually hold shares of the asset, then the price will go down. But this isn't because of short selling as such. What's happening here is that the market process is revealing the information that would otherwise go unrealized and unrevealed in the absence of a practice like short selling. So, if Casey has better knowledge than everybody else, and other people begin to accumulate that knowledge, then what's happening is not that short selling per se is driving down the price of the asset. The existence of short selling itself means that buyers and sellers of assets are converging on a quote-unquote more correct price of the asset. Okay? It's revealing that the asset is overvalued at its current price. Okay? It's not that speculators like Casey or short sellers per se are causing fluctuations in market prices. In fact, they're actually reducing the volatility of asset prices. As a result of the fact that this institution that we call short selling, this practice that we call short selling, allows the assembly of information about the true value of assets that would otherwise go unused, that would otherwise go unutilized, and that would otherwise not factor itself into market prices. So we have a choice between two things. First, we can have a situation in which people can short sell, and in which they can, as a result, we can see the price of the stock adjust in response to short selling behavior because people are using all their information, or we can outlaw short sales, and then price fluctuations are much more choppy. Because let's suppose, again, Bigelow's constant comment T. Okay, it's decent stuff. It's kind of citrusy. Okay, let's suppose that we realize. So let's suppose we'll use Casey again, our astute observer. Suppose that he gets wind of research showing that constant comment T causes cancer. Okay? His short selling might be a very, very, very good thing in terms of the information that's revealed in the marketplace. So the change in the asset price will start to incorporate this information, and you won't get the gigantic surprise that happens when the New York Times reports that constant comment T causes cancer, and everyone's caught in a position holding Bigelow T stock where they would really not like to be. So those people who hold it, they wake up, it's like, holy crap. The price plummets. And there are large opportunities to create value by reducing the volatility of the asset price that have gone unrealized. So any questions about short selling? Yeah. Okay. Yep.
And knowing or anticipation of that, the socialists cannot buy market information.
Okay.
The second case, I've seen cases that
Right.
financing.
Okay.
They short push down prices.
Okay.
They affect the fundamental.
Okay.
So they can profit.
Okay. All right. So what you've just described is a practice of basically short and distort. Okay. So by short selling, presumably by acting very, very bearish on the price of the assets in question, you can push down the market price of the asset and profit accordingly by quote unquote manipulating the market. Okay? I'm skeptical that this is really going to obtain in the marketplace. Okay? Why? 2 reasons. First, investors aren't stupid. Not all investors are stupid. You have people earning millions and millions of dollars making billion-dollar transactions every day. Okay? So if I am trying to screw everybody through a practice of short and distort, if I'm trying to drive down the asset price by shorting my stock, and you don't believe me, what should you do? Go long, right? Absolutely. So you should rise up to defend the value of the shares. Okay? And if this information is sufficiently widely dispersed, okay, then my short and distort strategy is not going to work. Second question. How do you know that someone's playing short and distort? How do you know? Seriously.
An owner of a
Okay.
was actually asking.
Okay. Yeah. That's exactly what short selling is. Is you're borrowing shares you don't own and then selling them in the marketplace. But how do you distinguish between someone's short sale that reflects their actual expectations and their actual feelings about the underlying value of the asset from someone who's just trying to manipulate the marketplace? Okay? That's a fundamental question. Okay? And one that I'm skeptical of the regulator's ability to answer. Okay? Because separating manipulative short sales from non-manipulative short sales will be extremely difficult. Okay? And then further, the incentive distortions associated with that suggest to me that this is something we should be very, very cautious about. Now, I've talked about the knowledge problem. And I think someone in another lecture mentioned the Nirvana Fallacy. Okay? The Nirvana Fallacy compares the world we live in with some nirvana in which, in the case of the government or in the case of a regulator, the regulators will behave exactly as we want them to and will, in fact, actually eliminate this distortionary activity in spite of enormous financial incentives to the contrary. Okay? So, Sheldon Richman from the Foundation for Economic Education said something recently that has really stuck with me. He said, just because some people cannot be trusted with liberty doesn't mean that other people should be trusted with power. Okay? So, my enthusiasm about the market is not necessarily because of some idea that the market is going to produce socially optimal, perfect, happy, wonderful time, always and everywhere, but that the alternatives are far worse. Okay? Yeah.
Any argument you make that
right.
Claim, they went long in this sort of
right.
market, someone bought a house or someone
right.
bought a company, increased the fortune of the company,
yes. Right. Yeah. Any argument against that's a fantastic point. Any argument against short selling is also an argument against going long. Okay, so for example, right now my wife and I have a long position on our house. Okay? Any of you who own real estate, you probably have a long position on your house. Okay? So home prices have declined. Didn't decline that much in Memphis. Somehow the assessed value of our home increased. Okay? Because apparently the county tax assessor is pretty much literally just making stuff up. Okay? But that's another discussion for another day. So any argument against short selling is necessarily also an argument against taking a long position, which in turn means that this is just an argument against ownership of any asset anywhere ever. Okay? I saw another hand a second ago. Yeah. Mm-hmm. Right. Right. Right.
And then they
okay. That's a great question. Okay, that's an excellent point. Right. Okay. That's an excellent point. So to clarify the question that was asked a minute ago about regulation. Okay, in some cases, bearish activity on a stock can be inconsistent with the fundamentals, which are the actual, the actual quality of the assets. can be inconsistent with the fundamentals, and it becomes a self-fulfilling prophecy. Okay, to that, we can respond again. So it is true that the market might make these mistakes. However, we need to know, and what the efficient markets hypothesis implies, note it is the efficient markets hypothesis, not the omniscient markets hypothesis. I got that from a reader of the Mises blog. I credit him. Okay. What this implies is that all information relevant to any transaction will be reflected in the market price. So, it is true that yes, perhaps a company might get destroyed when its fundamentals are good. However, you need to be able to have that information at the outset and be able to evaluate it ex ante to know whether this is going to happen. And in that case, you can actually profit from the information. You can evaluate it ex post and say, well, the market made a mistake. But if we're going to make a case for regulation, then this information needs to be available and knowable ex ante. Okay? Since it's not, then I don't think there's no case necessarily for how or why the government could improve on the efficiency of financial markets via regulation. Let's talk about futures contracts. Futures and oil speculators. Okay? This is always interesting because it has a couple of implications. Okay? Once again, people say, and this is something the government is looking into, people say, well, the changes in prices of oil are not due to supply and demand, they're due to speculation. Indeed, the people who are speculating on oil don't intend to actually take possession of the asset. They're just betting that the price is going to go up or that the price is going to go down. Once again, we're going to see that the market, in fact, actually increases its efficiency and smooths out its volatility when we expect, or when we allow things like speculation. So a futures contract is a contract by which you agree to deliver to someone at a specified date in the future a specified quantity of a specified commodity. So you might agree to deliver 1 barrel of West Texas sweet crude petroleum, okay, at a price of, I don't know what oil is going for these days, $100, we'll say. That's probably way too high. Okay. $60. All right, great. Okay, thank you. So that's probably much more accurate. Okay, so you can buy and sell futures contracts based on your expectations about price movements, and this is going to dampen the volatility of the marketplace. Let's consider two scenarios. We have the market for oil today. We have the market for oil tomorrow. And to be clear, why should we expect the price to be the same today and tomorrow? Abstracting from time preference. Why is the price of oil today going to be basically the same as the price of oil tomorrow? Arbitrage. Okay, arbitrage. That's a great word. Arbitrage, right? So what does arbitrage mean? Riskless profit. Right. Yeah, so basically riskless profit is arbitrage. Okay, so it says quite literally that you can buy an asset in one market at one price and sell it in another market at a higher price. So for example, a potential arbitrage opportunity might be to say, how many of you guys would pay me $2 for a Coke right now? Anybody? $2 for a Coke? $1 for a Coke? Okay. All right, so we got $1 for a Coke. All right. I'll be right back. Oh yeah, I'm great. Oops.
That'd be $1.
Thank you. All right. Okay. So I received an offer of $1 for a Coke and an offer for $1 for a Diet Coke. Right? Okay, there we go. Thank you. All right. What's that? Wait, I have $1? Okay. No, here you go. Okay. All right. You can have your $1 back, actually. All right. Because I would feel bad. You're taking the Mises Institute soft drinks and then selling them in here. But what this would suggest, and especially since, Joe Salerno, I guess, has some influence over whether I get invited back. I don't want to. Okay, so what I've done in this case is I would have successfully arbitraged the soft drink market in Auburn, Alabama. by going and buying Cokes for a price of $0 each, selling them in here for $1 a piece. So, in the same way, if you can buy a barrel of oil for $60 today and sell it for $65 tomorrow, you can arbitrage the oil market. We'll expect the competitive process to generate one price across these markets. So let's begin with these markets in kind of an intertemporal equilibrium. The first time I've taught intermediate macroeconomics one time in my life. That was at St. Louis University during my third year of graduate school. And when I was talking about Austrian business cycle theory, I suggested to the students that if they ever wanted to impress that special someone, they should drop the phrase inflation-induced intertemporal monetary disequilibrium into a conversation. I've not heard of any weddings resulting from that yet. Okay, so we can expect in the market for oil today and the market for oil tomorrow, we can expect basically the same price. So let's talk expectations. Question? Comment? Oh, okay. All right. Inflation-induced intertemporal monetary disequilibrium. All right. Now, recall if you're at my environmental lecture the other day, and even if you weren't, you might have heard the claim, we're going to run out of oil. Someday we're going to run out of oil. In 2075, we're going to run out of oil, or something like that. All right, so how might we reflect this on the graph, and how should we respond? What do we think is going to happen? Yeah. Okay. Okay, this is a great point. Okay, so oil's not a resource. The brain is a resource. Oil was this icky stuff that ruined land values until it was determined that, lo and behold, we can use this, we can burn this and create energy. Okay? We know that to be true. Let's suppose, though, that we're going to continue sucking up oil, and the population's going to continue growing, which is going to do what in the market for oil? Yeah, it's going to increase the demand. So what they would do, well, let's just to keep this simple, let's suppose that we have a fixed supply and just an increase in population. Okay, this was basically Paul Ehrlich's part of Paul Ehrlich's argument for population extinction based on resource extraction. Okay, so we increase, so demand goes up. We should see the price increase, or rather, we should see people expecting a higher future price of oil. So if you genuinely, honestly, deep down in the darkest depths of your heart of hearts, believe that the price of oil tomorrow is going to be $100 a barrel, what do? You buy now. Or, if the price is $60 a barrel, then what you can do is you can buy futures contracts for delivery of oil at $60 a barrel or $61 a barrel tomorrow, which you could then turn around and sell at the new equilibrium price of $100. What this is going to do, long story short, is this is going to induce people to pull oil off the market today. Okay? If you've ever filled up your gas tank in anticipation of a storm, this is exactly what you're doing. You're pulling gasoline off the market today, saving it in your gas tank, and then preparing to use it tomorrow. Let's use another color. Let's go with red. So, this will induce people to pull oil off the market today, and let's suppose this will just settle us on a new equilibrium price of $75. This is actually a bit of a mess. So we're going to invoke what one of my undergraduate professors called the Wavy line theorem. Well, tell you what, close enough for government work. All right, so we should expect to see as a result of this process. Good grief, what am I doing? Advice on test taking. Whenever you're trying to indicate an increase in the supply of something, remember the supply curve moves in this direction and not that direction. All right. So we reduce the supply today, we increase the supply tomorrow, and what we get is a reestablishment of intertemporal equilibrium, where the price of oil today is going to roughly reflect the price of oil tomorrow. Okay, and further, if you believe that we're running out of oil, and if you believe no one else knows it yet, you should be able to arbitrage the oil market. You should be able to act on this information and make boatloads of money buying oil futures. Further, this implies, for a lot of reasons, that we will never run out of oil in a well-functioning market economy. because prices are always going to adjust in such a way as to reflect all available information. That, in turn, higher prices will induce people to innovate. This will give people incentives to go out and try to find substitutes for oil. So, a derivative implication. Do we need subsidies to green energy? No. Not necessarily. Several years ago, I remember reading on Don Boudreaux's blog that when oil prices were really, really low, there was something like 7 venture capital firms in Silicon Valley dealing with alternative energy. When oil prices spiked and increased dramatically in 2005, 2006, there were something like 50. Okay? Right, so the market itself is moving to correct this. The market itself is solving the problem that we're probably not really going to recognize until after the market has already fixed it. Okay? So this is fun and interesting in a lot of different ways. Because financial markets provide us with the opportunity to act on our deepest core beliefs. I said the other day that I don't believe Walmart is systematically discriminating against women. And for that matter, I don't believe that the critics of Walmart really believe it in their heart of hearts. Why? What could you do if you genuinely thought that companies like Walmart are leaving money on the table in order to indulge a taste for discrimination? What would that suggest? Sorry? Okay. Okay, right? So on one, not necessarily a lower wage. Okay. Okay. Well, so what you might want to do is go out and start your own company. What else could you do? Take over. Right. So, let's suppose that Walmart is actually discriminating against women. What is this going to imply about the value of Walmart's assets? It implies what about their profits? They're lower than they should be. Okay? So what you should be able to do, and capital markets are relatively efficient, you should be able to go out, borrow a bunch of money, buy up as much Walmart stock as you can get, fire everybody who's making decisions, install your own people, and earn a handsome profit by doing so. Robin Hanson, on his blog Overcoming Bias, offers another example where people have said, well, clearly there's a lot of discrimination in upper-level management because firms that are headed by women tend to be more profitable than firms that are headed by men. So, if this is true, how can we take advantage of this information in order to profit and use the financial market to correct it? And use the financial market to correct this perceived injustice. If firms headed by women are systematically more profitable than firms headed by men, what should you do? Okay? Well, you could buy them out. Well, what else could you do? Being a corporate raider, that sounds sexy and cool, but it's probably really difficult. It'd be fun to go into a shareholders meeting with swords slashing back and forth like, you sir are fired. Clear out the entire board of directors. We own this company. Now we're putting in our people. Well, this is tough for the average investor. What can someone who just sort of checking Yahoo Finance and trying to decide on their own asset allocation, what should they do? Right. Yeah, they should buy stock in companies that are headed by women. And what should they do with their stock in companies headed by men? Okay? Dump it, basically. Okay? Or short sell it. Okay? They could do, there's a variety of things they could do. Financial markets are going to provide, I think, the kind of discipline that we want regulators to provide and would make things like the EEOC and whatnot superfluous. Because, particularly when you're dealing again with markets for stocks, with markets for commodities, for things like that, you're dealing with people who are earning non-trivial sums of money to make decisions involving even less trivial sums of money. And I'm pretty sure that guys at New York investment banks are not going to pass over profitable opportunities just because, they are misogynist or something to that effect. Okay? So, this gives us a couple of implications. It shows us what we should expect to see happen if Proposition X were true. There is discrimination, or we're running out of oil, or whatever. Further, it shows us how people should respond to that information, and it also gives us kind of an action plan, which is if you really deep down in your heart of hearts believe in injustice A, injustice B, or injustice C, here's how you should respond. So, that's this part of the song and dance. If anybody has any questions, comments, etc., we can continue our discussion.
I have a
Yep.
comment about the speculative
Mhm.
feature, but also future production. So
Right.
for instance,
Right.
so that's one or two things.
Right. Yeah. That's something I didn't really discuss. Is another one of the benefits of futures markets is it allows firms to hedge their future production decisions. So Southwest Airlines, for example, for a couple of summers in a row, I read stories about how wonderfully they'd done by buying futures contracts for oil at like $24 a barrel. Then the equilibrium price of oil ended up being something like $60 a barrel for the summer. And so they were able to get one of their chief inputs extremely cheap. One of their chief inputs extremely cheap. Yeah, so that's another benefit of having futures markets. Okay. Yeah. Okay. So if a company is innovating and being extremely risky in what they're doing, is this going to induce more short selling, more? Okay. 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 A priori, I'm not sure. So it's not clear that like high risk firms are going to have more short selling or less. Okay. Their ability to raise capital in an initial public offering is going to be determined primarily by future expectations. Quiz. Antitrust authorities are currently looking at going after Google. Okay. What do you mean why? They're a monopoly. They're monopoly producers of a product that didn't exist like 15 or 20 years ago. So, yeah. They don't need an argument. Okay. Yeah, well, okay, yeah. The argument is they control too much of the market for online advertising. And since apparently they do, that makes them a monopolist. One of the things that was interesting, and I put this on our blog Division of Labor, a little bit ago, is in reading an article about how the antitrust division is going after Google. One of the options on the CNN Money article was share this using Google, AOL, Yahoo, Twitter, Facebook, Delicious, Reddit, StumbleUpon, MixMe, like 4 dozen different information aggregation sites on which you could share the CNNmoney.com article about how Google is apparently a monopolist. Okay. Odd. Okay. Back to financial markets. So if you think this prosecution is going to be successful, what should you do? Yeah, you should short Google stock. Okay. How? Why? Well, because if antitrust is successful, that's going to drive down the share price. Okay. And therefore, this might provide people with an incentive to short the Google stock. Now, here's a paper idea for those of you interested in the empirical analysis of financial markets. Within the last couple of years, someone has looked at the stock portfolios of Congress people and has found that they vastly outperform the market systematically. So you have some amazing financial geniuses working in Congress. Something that would make some interesting detective work, and this gets back to this question about whether regulators can regulate rationally or whether we should really trust them, would be to look and see if you can find the portfolios of people who work, say, for the antitrust division of the Justice Department. Okay? You can find some information on that and see if you see a bunch of guys who work for the DOJ short selling Google stock. Right? Then this might suggest some things that are about to happen, and then further, this would give us information about desirable market institutions. At the Economic History Association meetings in 2002, one of the presentations was by an economist who worked for the Justice Department, and he said, a lot of economists give me a lot of flack for working for the DOJ, because they do all sorts of silly things like go after Google for being a monopolist. In fact, you should thank me because my job at the DOJ is to prevent the DOJ from doing everything the DOJ wants to do. Okay? So, no, I'm still not entirely convinced, but nonetheless, I guess it's good that he's there on the front lines. Other questions, comments, thoughts? 1, 2, 3. Okay, comment on naked short selling. All right, so naked short selling. Bob Murphy has a great article about this on Mises.org. Naked short selling is not as sexy as it sounds. In fact, actually, what you're doing when you engage in a naked short, and I borrowed that line from Bob. Okay, when you engage in a naked short, you're short selling stock you haven't borrowed yet. Okay, So that's just the difference between a naked short and a regular short. Regular short, you go out, you borrow the shares, and then you sell them. Naked short, you sell a promise to deliver shares, and then you go out and find the shares. Okay. Now, why would someone want to engage in a naked short, and is this in some way unsavory? Okay, generate interest income. That's one thing. Okay. What else? It also might be extremely costly to go out and find shares before the fact. If you're dealing with very finely tuned information about what you think is going to happen to a stock, then you might be able to profit for it if you can sell the shares before you go and find them. Okay. So anyway, long story short, that's the difference between naked shorting and regular shorting. How would you be able to find? Okay, how would you be able to find the stock portfolios that I'm talking about? I'm not really sure. Look for I'm sure there's some type of disclosure regulation such that, and I would guess that if you work for the antitrust division, there's certain transactions you're probably not allowed to do. Okay, so if you have now one thing you could do is look in like the early 2000s, late 90s for people with the last name Reno, and see what they're doing.
They don't necessarily have to short it though. If they just own proportionally less than the average population, that's already evidence of.
Exactly.
And that they can do.
Right. Definitely. Yep. Yeah. Okay. You were going to ask about naked short selling. Okay. Other questions? Wait, Doug, did you have something to say? What's that? Oh. Mm-hmm. Okay. Yeah. If they're okay. All right. If they're unable to find the shares, then I would assume the contract is canceled with some sort of penalty. I don't know the specific details. Okay. Right.
A lot of hedge funds got in trouble.
Right. Okay. Cool. Thanks. All right. Yeah. I don't know the specific details of say like naked shorting and its role in the financial crisis, but just assume there was probably some penalty for it. Yeah. That's an interesting question. Is the concentration of market activity under the auspices of hedge funds distorting the prices of assets? Okay. Short answer is I don't know. If I did, then I should be able to presumably act on that information and profit from it. Okay. One thing that we can know, one thing that has come up in a couple of contexts, is the nature of regulation in financial markets, where a lot of the like sort of deep, extremely opaque financial instruments that are being traded now are responses to the regulatory infrastructure that was designed to fix whatever problem we wanted to fix in the 70s, which created problems that we wanted to fix in the 80s, which created problems that we needed to fix in the 90s, which created problems that we want to fix today. I'll give you an example. Think about the drug war. What's the big drug that everybody's worried about right now? Meth. Right? Meth. Yeah, so I remember going to an Alabama football game and seeing this giant banner advertisement for zerometh.com. Okay? Right, so the drug of choice during this decade is meth. We have meth today because we cracked down on crack in the 90s. We had crack in the 90s because we cracked down on cocaine in the 80s. We had cocaine in the 80s because we cracked down on heroin in the 70s. Okay? And so on, and so on, and so on. In much the same way, one of the reasons why we have problems in this tiny sector of financial markets is because we tried to quote-unquote fix problems in another sector of the financial market 5 years ago, 10 years ago, which were created because we tried to fix another sector of the financial market some number of years ago. This is in a bunch of different places. Mises talks about sort of compounding intervention. It says one intervention creates distortions, which have to be fixed by further interventions, which create further distortions, and so on and so on and so on. Which gets, again, back to my skepticism about the desirability of regulation, is that there's no way to, quote, fix it. Yeah. Should the Glass-Steagall Act have been repealed? Yes. Okay. Did the repeal of Glass-Steagall cause the current crisis? I doubt it. It's a convenient scapegoat. And further, it really allows for, it allows for and reinforces the deregulation caused the financial crisis narrative. Okay? Which again, unfortunately, there's no good theory for that. It's just, hey, we had a financial crisis. Let's see what happened before it. Oh, we repealed Glass-Steagall. Therefore, repealing Glass-Steagall caused a financial crisis. 1, 2. Excuse me. Day traders are unproductive. Okay? Are they? What are they producing? They're producing information, right? Okay, so day traders are producing information. They're helping to better align the prices of assets with what the prices of assets would be if everybody had perfect information. Okay? Right. Okay. Okay. Okay, that's another good point. Okay, so in addition to providing information, they're also thickening the market. Okay, so yeah, right, yeah. They provide liquidity in the market. Okay, so day traders are not unproductive leeches. Day traders are global financial heroes. Okay? Yeah. Oh, sorry. Okay. Short squeezes. No, I'm sorry, I can't. Okay. I'll be honest, I'm not really familiar with the term.
It's when there's a fail to deliver. What happens is you're forced to go out and buy the longs to deliver them, or else in breach of contract, basically how they get screwed over. So you're forced to go out in the contract. So suddenly all the shorts are all going and buying because they're desperate for the stock to the guys who are demanding the stock. And they get squeezed and shorted.
And the people who are shorting becomes like a...
Okay.
And that's like...
That's the solution of the world for one day.
Okay. Okay.
That's punishing the shorts.
Right. Yeah. Okay. So the question is, so short squeezing, which is when a bunch of people who have naked shorted have to go out and cover the short and bid up the price of the asset. Does this cause more volatility? Not necessarily, because one of the things it's presumably you're going to be willing to accept the risk associated with being put in that position. Okay, and one of the reasons why why various assets might have been more volatile recently might be due to monetary policy shocks, or something like that, or changes in financial infrastructure that alter returns to certain types of activity. Yeah. Okay. Oh yeah, totally. Yeah. So if you see an opportunity like a massive explosion in the price of Porsche shares because a bunch of people have to cover their short positions, then yeah, that would be a way for a firm like Volkswagen to come in and basically take over a company. Okay. So is it going to lead to you might have short run volatility if a bunch of people systematically make a cluster of errors, which of course then we have to explain why people are going to make this cluster of errors. Okay, but over the long run, this should all smooth itself out. Yeah. Okay. Could I comment on the similarity between naked short selling and fractional reserve banking? Okay, so since I'm not really a participant in the fractional reserve banking debate, so I can see where the two are similar, but I'm not really sure. If I can take Walter Block's argument, I'm not really sure that naked shorting would be fraud in the way that fractional reserve banking would be fraud. And if I take, say, the Larry White George Selgin argument, then yeah, they both might be the same thing, but they're perfectly legitimate contracts. Doug, do you agree? Disagree? Okay. Okay. Right. Yeah. Right. 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 Okay. Yeah. Yeah. So that may be a very so there probably is a similarity, and again, sort of continuing the great paper idea meme. I'm sure Professor Salerno left, but I'm sure that would be a very interesting paper to write. Yeah.
About insider argumentation.
Okay. Is there any Austrian argument against insider trading? No. Okay. Why is insider trading bad? Okay, because greedy people are making profits. The argument is presumably, well, people can manipulate stock prices and things like that. But once again, what insider trading would do is it would create the information that will reduce volatility in the marketplace. Okay? And then further, one thing you could do is you could look and see what all of the executives are doing, how they're allocating their portfolios, and then act accordingly. Okay? So what rules against insider trading do is basically they destroy knowledge. Yeah. Oh, sure thing. Yes. Yeah. Yeah, absolutely. Allowing insider trading is going to benefit the people who get the information first. Definitely. So, right. Mm-hmm. So the question, and I think unfortunately the regulatory idea is that markets should be like spins on a roulette wheel. Okay? Which is unfortunate. Okay? Because what the market process does is it assembles all of this information and allows for rational economic calculation. By destroying the information, yes, it is true that if you have inside information, then you're going to benefit first. But this redounds to everyone's benefit by making rational economic calculation possible. Let's consider a similar issue. Tickets to sporting events. Okay? There's a huge market for sporting event tickets. Okay? There are all sorts of other markets for different kinds of things. So one thing I do is when I go to like football games and whatnot, I'll try to see if I can make money scalping football tickets. The Alabama-Arkansas game this past year, me and 3 of my friends went. I made $65 and sat on the 40-yard line. It was awesome. Okay, so had there been some exogenous shock to market conditions, had it rained, then maybe I wouldn't have been able to do this. Another example: before the Alabama-Auburn game this past year, and as an Alabama graduate, you can figure out my preferences on this. So the night before, I'm flipping through the TV stations, and people saying, "Oh, it's going to rain tomorrow in Tuscaloosa." And I said, "Okay, I'm going to need a poncho." And 90,000 other people are going to need ponchos too. So I drove to my nearest Family Dollar, bought every poncho they had. Okay, I only ended up with like 17 of them or something to that effect. Okay, and then went to the game holding up a sign saying ponchos $5. Did it rain? Not really. Now then, I sold enough of them to cover my losses, and I now have a drawer full of ponchos in my house in Memphis. Okay, but in the same way that we can say, well, you benefit first. If you've got the inside information first, and therefore everyone has a claim against you. Don't I have a claim against somebody since I speculated incorrectly? I expected to make over $100. I didn't. I made like $3. I made enough to buy a Coke. Okay? So anytime we're going to make some moral claim about the quality of a market outcome, that claim has to be symmetric. 1, 2.
Yeah, but suppose you're the CEO
Mm-hmm.
and you're doing short selling
Right.
on your own company
Mm-hmm.
and you messed up on purpose
Okay.
with the short selling. Is there any way shareholders might
Mm-hmm.
not allowed to do so?
Right.
There are examples where there is a moral hazard in it.
Right. Okay. So this is an interesting question. Yes, there is moral hazard, and that's true. So 1, firms can contract around this. 2, what happens when you get caught? You're gone. Right. So if I know that the CEO of a company that I own stock in is manipulating the share price to his own benefit, I'm going to vote for his ouster at the next shareholders meeting. And further, and John Lott discusses this a little bit in his book Freedomnomics. I don't know if he talks about this specifically, but the present value of the gains from manipulating your firm's stock price, I would guess, is very low relative to the present value of your future earnings as an honest executive. Okay, and again, and I think, and I'm going to toss this one out as I think what would be a great paper. What would be a great paper for somebody to write, because I don't know specifically. Yeah.
What I was trying to figure out
Mm-hmm.
the inside of my plan.
Right.
So it tells me information that is not public domain yet.
Right.
I still have to like
No.
pre-marketing for.
Okay. 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 So this is going to have to be the last point because we're out of time. So how would the free market prevent insiders from sharing information with friends? Okay. Short answer, I don't know. I don't know the specifics, but once again, the capital market and the labor market for executives is sufficiently competitive that people who are extremely dishonest and who are manipulating share prices for the benefit of themselves or for the benefit of their friends will generally get competed away. They'll get their capitalist comeuppance. And again, I want to reiterate the knowledge problem and the Nirvana fallacy. So, the prospect of a difficulty with the market is not a prima facie case for government intervention. So, go with that. Good luck on the exam this afternoon. Thank you.